Rates just went down. Hell yeah. Wait a minute. They just went back up. What the hell is going on? What is pushing these rates up and down like this and keeping them high? More right after this. Hey, Brian Thompson here. Remember, anything you want to know about the greater Phoenix area, you're going to want to hit that subscribe button, smash that bell. This is what I do. Do it full time. I absolutely love it. Days, weekends, nights, call me, text me, email me, whatever. I'll go ahead and get back with you. Anything you want to know what it's like to eat, sleep, drink, play, work in the greater Phoenix area, I'm your man. So again, reach out anytime. Love what I do. As my subscribers know, I always like to give a good shout out for a good t-shirt. Little Breaking Bad, believe it or not, January 20th, 2008 is when it debuted, over 16 years ago. Feel old yet?
Old?
Okay, so what we're going to talk about here, a little bit about what moves the market. Probably my least favorite topic, but get a ton of questions from clients, previous clients, friends, family. What's the market like? What's moving the market? Why aren't rates coming down? So there really are two things that move rates. It's really only one, but two things. And the two are the federal rate, which is basically inflation numbers. Usually those numbers aren't correlated because the Fed rate is a short-term rate. So think more like car loans, think more like credit cards, things like that. But we have, for some reason, been following right along with the Fed. Some inflation numbers are what's moving last week. And again, I'm doing this at the beginning of February 2024. Last week, we saw a great decline in rates, and then all of a sudden some news came out about that is not good for the inflation numbers, and then things skyrocketed up. So something that if you really dig into the numbers, which we're gonna do here, just as an example, really was not as good news as everybody thought it was. So again, I'm gonna talk about the Fed. So it's been 4 times that they have not raised the rates when we went through some crazy rate adjustments. And actually, Powell just announced on Sunday, and Sunday would be the 4th of February, that they weren't going to raise again in March. So how he knows that already, I don't know. It's crazy that he can even, because the inflation numbers are looking better and better, which would be a decrease in rates. So no raise, no decrease coming up in March, according to him. So that'll be 5 in a row for no raise or no decrease. So we're staying pretty stagnant. But they meet again in May, and when May comes around, I'm telling you right now, we're going to have some big movement, if not before then, in mortgage rates. Big movement. And what that means, if you're thinking about moving anytime this year, buying, selling, anything that has anything to do with rates, because as a seller it does affect you as well, because it gives you more of a pool of people. Get with a lender and see, at least get qualified. I'm not saying lock anything in, just see where rates are right now. Get all your information in, because it's going to be a frenzy here in the Phoenix market again. So that's my suggestion to you. I mean, do as you wish. People keep saying I'm waiting for prices to come down. Look at some of my other videos. Prices in the valley are not coming down. And I'm going to show you another chart on here which shows that housing is one of the safest things that you can invest in. Some crazy numbers that you're going to look at here shortly. I'm going to go ahead and talk about home value. So, hey, real estate agents, you guys always talk about buying a home. That's what you do, talk people into purchasing. Here is some concrete numbers as to why it's a good idea. So go ahead and take a look at this chart. This is since 1942 on the value of your home if you would have spent $100,000 on a home. So why 100,000? It's just a number, right? I mean, we could have picked any number, but 100,000 here. So the only time that if you purchased a home that you would have lost money 10 years later, from 1942 to now, is in 2006. And we all know the craziness in 2006, the huge inflation and then the crash afterwards. But look at the numbers from 2007 all the way till now. So, a little over 100,000. If you would have purchased a 1% increase in 2008, 10 years later, so 2018, you would have seen a 13% increase, 2009 a 34% increase, 2010 a 45% increase, 2011 a 67%, 106, 105, 98. I mean, we go over all of them, but these numbers are crazy. This is why, and if it's historical. Look, 10 years later, you're going to have money, and there's people that are purchasing homes that don't have any kind of investment whatsoever except for their home. Nothing. I mean, maybe they work somewhere that doesn't offer a 401k. They don't have any investments other than their home. So it's important to purchase a home. Stop renting if you can. You don't need to be house poor. I get it. That's a terrible thing, but purchase a home if you can. You can see here. So again, the realtor rant, if you will, but here's some concrete numbers on why. Let's talk about what moved the rate. So as you look here, our 10-year yield is showing you where rates are. The Fed does not show you where rates are. So the 10-year yield, you're looking at a number here, and this is looking at over a month, and you can see that big drop that we had. So typically, you add 1.7% to where the 10-year yield is, and that's where you're going to see where a 30-year fixed is going to be. We are well above that. Again, another reason why rates are going to be coming down. But anyhow, see the big spike there? You can see the chart here where it's nice and low in the 3.8, and all of a sudden, boom, it's back well above 4 again. Well, here's what happened. So we came out with our jobs report, and this was on Friday. So the jobs report is basically saying that we came in with over 353,000 new jobs, which was projected at 180,000. And looking at this chart, this is from Barry Habib, has been doing mortgage analysis for a long time. But those are seasonal jobs, okay? So we added 353 of the seasonal jobs, but you look at what our non-seasonal adjustment is, we lost 2.635 million jobs. So you're looking at that and thinking, we come out with 353, great, everything's looking fantastic. No, it's not looking fantastic. We lost 2.635 million seasonal jobs. So those are all the people who worked in the department stores and things like that over the holidays. They lost their jobs, gone. So the whole plus sign in front of the 353 is not accurate. So, and also saying that our hourly earnings went up 0.6%, as you can see here, month over month. That's what the MOM is. That's not true either, because we worked less hours. So we worked 34.1 hours per week in comparison to 34.3 hours per week. So when you do the math for somebody who's salaried, and let's say they make $50,000 a year, they're going to make the same every month. Well, if they're working less, that doesn't mean that the average earnings went up, right? They're making the same no matter what. So it is very much a number that you cannot look at and take it seriously. But this is what moved. As you can see the movement here, this jobs report came out Friday after you see where the rates are really down. You can see the huge decline again, or incline here again on the 10-year, and it just doesn't make sense. It doesn't make sense at all. And then you look at this chart here that I have. So the full-time jobs in January lost 63,000 full-time jobs, and over the last 3 months we've lost 1.369 million jobs. All right, but part-time jobs in January increased 96,000 and has increased 858,000. So roughly about 500,000 jobs you see there have gone from full-time jobs to part-time jobs. That's not good, okay? So we're making it look like we've created all these new jobs and everything. It's not true. We're losing jobs. So that should be driving rates down. So Now let's talk a little bit about the 10-year, which is the second thing that we're going to go ahead and look at. And that is the one you're most accurately going to look and see the ups and the downs. This is just right off the internet. You can look and see what's going up and down. And you're going to see, if you're in contact with a mortgage lender, they're going to say, hey, rates have dropped. I guarantee you can look at the 10-year and see that it is declining as well. So, yeah, I mean, that is the way to go for that. Don't really follow what's going on with the Fed numbers as far as thinking that's going to affect mortgage rates, because it sets the prime rate, which is going to be, again, your HELOCs, your credit card debt, your auto loans. And auto loans are high right now because we have not come down. But I'm telling you right now, I think he said maybe there's a 20% chance that they'll lower the rate in March. If we do not, look for a frenzy in May. When they do lower the rates, things are going to go nuts. So again, please listen to me. If you are thinking about purchasing a home in 2024, talk to a lender as soon as possible. Again, if you can get in before the craziness, so low rates will get more homes on the market because sellers want to go ahead and sell, get a low rate themselves on the new home. There's going to be a lot more buyers out there. It is going to drive prices up. Some of the places in the market, and you can give me a call and I can tell you exactly, some prices are down right now. Homes are sitting a little bit. A great time to buy right now and then refinance when rates come down. But please listen to me. The frenzy is coming. This is the calm before the storm. Again, hit the subscribe button, ring the bell. Would love to get more information from you. Reach out to me anytime. This is just a quick overview of where the market is, what drives rates. I do not like talking about it because this is one of those things that everybody has an opinion about it. This is just facts that just came out. So again, please, 2024 is your year. Start the process now. So reach out anytime. Thanks. Talk to you soon.